Welcome, everyone. Thank you so much for joining the Nest Edge. This is a live webinar that we provide to clients and anyone who is interested in learning more about investments and finances. Just to let you know, this is only for educational purposes. This is not considered investment advice. We strongly believe that education is so important to make informed decisions. So we love doing these webinars to educate our clients and anyone who wants to learn more. My name is Gloria. I'm one of the advisors at Nest Financial. And I also have Sean McDougall joining me. He is the portfolio manager for Nest as well. If you enjoy our webinars and know somebody who is also interested in learning more about the investment world, please feel free to send this over to them. We have these on a monthly basis, and so yeah, we will get started. Also, if you have any questions, please feel free to add those in the chat box. If you are asking about certain recommendations about buys or sells of various investments, that is not what the Nest Edge is for. So if you are seeking advice, please feel free to email us at info@nestfinancial.net to schedule a call. So Sean, good to see you outdoors, enjoying the nice weather.
Yeah, pretty much. This is where I work from now at this time of year. It's awesome. About 6 a.m. to about 3 p.m. This is my little spot. I love it.
Nice. So for this newsletter, we'll be talking about the topic, which bubbles are fun until they're not. This is a very interesting and timely topic, and a bit worrisome since the last one happened about 12 years ago, and as you know, wiped out hundreds of billions of investor dollars. And unfortunately, it's something like this is usually not noticed by the mass public until it's too late. As we saw in the past, a big shift like this can cause major disruptions in not only the investment world, but also can lead to did lead to one of the biggest crashes in the largest consumer-based markets, which is housing. Not to also mention millions of layoffs. So, what we're seeing now in our environment is all-time highs in equity markets, low interest rates, massive push of a stimulus into the economy, surge in home prices and purchases, and somewhat of a job recovery. So let's dive into the discussion. So Sean, can you give us a bit of history about, what we saw from the last bubble and if this environment feels the same?
Okay, so first and foremost, the biggest thing I want everyone to take away from this thing is the word bubble is a financial media, mostly hocus pocus word. It's garbage. It's for the most part useless. As I mentioned in a little blog, like there's bubbles constantly and all the time. Like there's things that are like rapidly expanding for no reason and vice versa. Everyone kind of harps on, the housing 08 and then the tech one in, 2000. And sure, those were major corrections. There were some issues underneath the hood to where major issues were going on. But I hate when people say, oh, it's just a bubble, it's going to crash. It's just so damn lazy. But comparing now to 08, no, it's wildly different. 08 was a housing issue that just kind of bled into everything. Are things at all-time highs right now? Yeah. And are things probably disconnected from the economy? Yeah, probably. But the economic data right now is great because of where we were. But did that answer your question? I feel like I rambled too much that I even confused myself.
No, you answered it. And also that kind of leads me to my next question about, you slightly touched on it about the media, calling things a bubble.
Yeah.
And also wanted to touch on why this is considered a lazy narrative, since it's so popular, used by not only financial media, but I'm sure several advisors have said the word bubble this, bubble that. Can you elaborate on that? Like
It's
why
just
it's lazy narrative.
because if people, like, I don't know why it's not real. Like if you're not long something and okay, I'm just going to, I'm trying to think of something that's weird that we're not long. We're just such a bunch of weird stuff right now. Lumber, for example, is a commodity, but we're not long it currently. Let's say you were not long it and you were just like, oh, it's a bubble. You don't want to own that. It's a way to discount or discredit something that's going up that you don't own, in my opinion. That's what most people say. Oh, it's just a bubble. If you're just speculating, it's just a game. And you're like, well, you're saying that, but largely because you don't have it and you don't understand. If you knew for damn sure it was a bubble and it's just ripping, you should be there. That's what you want to do, is own things that are going up. Like it's just a lazy argument of you missed it. You don't know why you missed it, so you're just going to call it a bubble because it doesn't make sense to you. And people get caught in this trap to where they've worried so much about the why. Why is this happening? Why is this happening? Why it's happening and it already happened? No, it's gone. Like you get too hung up on the why and not the what. Like what's going on right now.
You talked about in the newsletter about how playing the game that you're in, that's right in front of you. And can you talk more about that? Like, because I feel like that relates to people talking about bubbles and saying you missed out, but it's like, well, you're not playing what's right in front of you.
Yeah. I mean, playing the game in front of you is, it's mostly that, because I know where I was going down the rabbit hole with fundamentalists. They're like, well, according to so-and-so's rule, this should happen. This should happen because of that is happening. And they'll position because of historical, like, well, 1 + 1 always equals 2 historically. Like, well, depending on your time horizon, maybe not. Like it doesn't always, there's correlations that build up and then dissipate and then build up again and then dissipate, as in like gold and the US dollar are inversely correlated, or maybe they become correlated for like 6 weeks. That's fun. And then it goes away. So the idea that we live in this world where everything there's, if you purely just look at the history and assume everything in the future is going to replicate that, especially in the investment world, is just lazy. It's not very creative. You're not moving. You're not advancing your strategies, your brain power, because most of who you're trading against is machines, and I promise you, they're learning and thinking all the time. So that's where the game is going to always get harder. Is most trades are algorithms that are just running. Now that doesn't mean we can't get an edge on them, because most of the yahoos that are building these algos are idiots when it comes to trading and what they're talking about. So there's advantages there, but if you are stuck running I use the fundamentalists because that's just the easiest low hanging fruit. If you're just trading on PEs, you're gonna get killed. I mean, it's just it's just a lazy old way of doing things. And you're like, well, that's the way it's always worked, and it'll eventually work again. I'm like, all right. So in 7 quarters, you might be right, but for the next 6 quarters, you're gonna get your face ripped off just because what should happen and not what is happening. You need to pay into what's happening. And that's where it's just lazy, in my opinion. Again, this is all my opinion. I'm not right every single day. We're long natural gas, and that's down today. I bought more of it yesterday. So, like, I love saying that anyone that says they know what's going to happen for sure, or they know what's coming down the pipe, is just totally full of it. I definitely don't know.
Well, but you do have a process, and I think sticking to that process has led to and will continue, success.
Limits your mistakes. And when you're wrong less. And it's all about the very beginning of my career. You don't really have the most important thing that I've gotten better at, and that's just a lot of trial and error and listening to other people talk, is the sizing of your positioning is so important. When you're right, hopefully your sizing is right in that you had a large position of it. And when you're wrong, hopefully you have a smaller position in that wrong position, because there's things that are going to work every single day and there's things that are not going to work every single day. You're just trying to get the overall line to keep going up and to the right. So having a process for increasing and reducing sizing is so damn important.
So, Sean, do you believe that there is a bubble, like that there is a time where, the equities market might face a huge crash, not necessarily,
Yeah,
towards the end of the year, but maybe next
yeah, that's
year? Is that, what do you think?
first and foremost, I don't know. It depends on, between now and the end of the year, it's very unlikely. Is it possible next year? Sure. Everyone kind of forgets that we had a big crash last year.
Yep, out of nowhere.
So
Not out of nowhere, but
Yeah, we knew something was coming. We knew a major correction was coming just because of the data was slowing at an accelerating rate. Like, okay, that's why we had very little, and most of our models had zero equity exposure. February 1st, 2020, and that wasn't just because we saw COVID coming, because that's ridiculous. We did not see that there was going to be a pandemic that, at least my generation has never seen. That's ridiculous. But we did see a hand grenade coming down the hallway that just happened to be a cannonball and just took out all the walls. So, and I'm kind of just making up terms here right now, but I'm trying to be creative on something that's boring. The data was slowing. We knew we were going to have an adjustment at some point, and then just COVID made it way worse. Are we ramping back up into that place? Yeah, we always are. We're always working towards the next correction. We're always working towards the next bubble in the equities. Are there some things under the hood that make me kind of worried? Yeah, but not in the near term, especially with how active, federal, the banks have become. It's the central banking, they take a lot of that risk away, which is a problem. So people feel more emboldened and they're just buying crap. Like, oh, it's fine. The federal bail is out. If the second that there's any volatility, somebody's got our back. That's good for in the short run, but at long term, eventually, yeah, there's, at some point there will be a substantial, rip, and it's not going to be overnight, and it's not going to be a straight line like we saw with COVID. Most, major bubbles or corrections are like, if you miss the first turn, there's always going to be another opportunity. So you fade out. People get so worried that they're going to lose 30% of their position overnight. And like, well, your sizing sucked then. Like, you were too concentrated. That's why I brought up a few minutes ago, like, sizing is so important. But there's quite a bit of blood out there today. We'll see what happens. I don't anticipate anything between now and the end of the year, just because growth and inflation are picking up. They are up. Next year, if you were going to put a gun to my head, I would say if we were going to have a meltdown scenario, Q2 of 21 is possible. It's probable that like some serious volatility is coming down the pipe in Q2. That's just because all the data it's looking like it could slow. And again, I say the word looks like, because once you start projecting out, in my opinion, over a couple of weeks, you're playing the probabilities game, which is powerful and important. But to say that for sure, again, is just crap. You really are, guessing when you start looking quarters out. You don't know. Like, it's ridiculous. I love, every now and then you'll see these articles, because you have these yahoos on CNBC, like Tom Lee, come out there and be like, oh, I anticipate in 2022 the S&P is going to close at X number on the end of the year. I'm like, you need to start fact checking these bastards, because when they do, it's embarrassing. Like, they're never right. They're never, like, even in the zip code. I don't know. I'm ranting. So probably let's move on.
Okay, so Sean, you had mentioned that, yeah, things are ramping up a bit towards the end of this, going towards the end of this year. For those who are new to the webinar and new to the process, can you explain how your process works in managing risk, not being too over concentrated, and your the limits that you place?
Well, yeah, how we manage risk is God, I could talk for a day for about this. But
Or
really
5 minutes.
it's, yeah, 5 minutes. Okay. I'm not good at 5 minute explanations because I just wasted 10 seconds there. Understanding where we are from a macroeconomic perspective, the two biggest causal factors that change markets or move markets, that causal is a fancy word for causing, factors that move things, not just in equities, but currencies, bonds, and commodities, is the rate of change of growth and inflation. That is step one, is figuring out what are those two factors doing. Are they accelerating? Are they decelerating? And specifically, what is the rate of change of those two things? That's just kind of where you start. And then once you figure out what kind of an environment that it's probable that we're in and what's the probable environment that we're going into, whether with growth and inflation, there's things that you want to have and there's things you want to avoid. And once you kind of understand, okay, we're here, we're probably going over there. Here's the things that I want to have, with me, and here's the things I want to avoid. Once you start figuring out the basket of goods that you do want to have, then you start looking very specific, into the data on those things. What's the, price, volume, and volatility of those positions? And then you can kind of figure out when you're going to fade in and out of them. The sizing is, 5 minutes is impossible. The sizing, without getting too jargon, you have to do what's called beta adjust the position, which means the more volatile it is, the smaller of that position you want to have. The less volatile, the bigger you can get into. And we have 5 different strategies. Each strategy has a little different, what called your core, which is like your minimum position, and then your max. So like our alpha position, the core on equities is 4%. The max is 8. When you go to moderate, it's the core is 3 and the max is 5. So you like even in like you can adjust. It's kind of like bowling lanes, like with the guardrails. For our more aggressive models, we might, we extend the bowling lane, making it going farther, but you can hit more pins. And the more conservative ones, we shorten up the bowling lane and we tighten up the lane. So like, there's different levers that I will pull depending on the model and the strategy. The strategy are all the same. We have the same outlook. It's just we execute them slightly either more aggressively or more conservatively, depending on the goals of that model, whatever stated return is trying to do. Did that explain your?
Yeah. Yep. You did great. You did great. That was like
I had
2
so
minutes.
much coffee this morning that like my brain is like. So
that was awesome. So Sean, I'm gonna throw you not a curveball, but something that that you mentioned in your newsletter that's a hot topic, which is Tesla. You mentioned some news about Tesla. Hertz starting that contract, not necessarily closing it, but announcing that contract. And why aren't we in? Well, I'm sure there's this questioner. Why aren't we investing in Tesla? But can you talk more about that?
The easy answer of why we're not long Tesla is there's things that I like more. The things that have more upside with less, without the massive amounts of downside. Tesla is a very iconic and culty kind of a position. People really buy Tesla because not so much the P&L statement or, their balance sheet or anything like that. It's just they just believe in Elon Musk. If we want to be really honest with ourselves, this is a vote that this man is a genius and he's going to do wonderful things in his life. And I'm not arguing that. The guy's, smarter than I am. But to just blindly buy off the Hertz announcement, as soon as it happened and I saw it rip like 30%, I was like, huh? And I love that even Musk came out and he says, like, I don't understand why this price is going up the way it is. As I said, Tesla does not have a demand problem. It has a supply problem. Its biggest problem is making enough cars to sell. So them getting an order for 100,000 cars does not mean they're going to be able to produce 100,000 more cars than they did last year and make more money and sell more cars. It just made the stock more expensive. And that's a term, that's a buzzword, but that's what happened. And so buying into it was just insanity. I mean, that's probably why it lost 12% yesterday. It's like the thing has just got so much expectations have been pulled in and priced into what, like, if Tesla doesn't eventually sell every single car that's on the street, cure cancer, and make alcohol that doesn't give you a hangover, they're probably overpriced. Like, it's like so much expectation has been built onto this position. It's just it's wackadoodle, in my opinion. I'm not talking bad about the man or the car. I like the cars. I think the guy is very interesting. I'd like to hear him talk more. I take that back. He's a wackadoodle, but a brilliant one. But the idea that, the valuation relative to other auto manufacturers, it's just wild. If I could wrap that up.
Yep. Talk about irrational markets. So
yeah,
to stick to a process.
Yeah, everybody people tried to, I guess, one random question, and I guess this confuses people when I respond this way. They're like, hey, I'll get a text like, why do you think X, Y, and Z is doing this today? I'm like, I don't know. Like, people get too worried about the why. Like, I'm not saying it's not important, but like, they want to hear the why. They want to hear the narrative. They want to understand it. And I will tell you that's less important. And if you really focus on that, and that's your number one thing, you're going to get a lot more wrong than right. Just don't get so hung up on the why. It's the what and what's going on that's just as important. Narratives will whisper sweet nothings in your ear, and then 6 months later you're like, well, this is just short-term volatility. I still believe in the position. I'm like, oh, you mean the narrative wasn't right in the short term? You just lost your ass in the position, so you're just gonna talk yourself into holding it longer so you can at least get your money out of it. I mean, I don't. It works for some people, not for me. It's a very loosey goose way to do it.
Well, that's great. That's why our clients hire us and you to make these emotional less decisions.
Zero emotion. Zero.
Yeah.
I don't care. I have no favorites. There's no opinions. I just don't care. I think my personality, you can fall in love with positions and justify it and tell yourself 100 times why it works or will work eventually. And like, I've done it. Like, I've made every mistake you can. And that's a strength of mine, in my opinion. Because I've seen how you can kind of talk your way into them. Like, Dropbox. Oh my God, I fell in love with that position. And it ruined me. Like, I lost sleep over it. It was not great. 2018, 2017, it just ruined me. And that's, you got to learn to just be unemotional about it and figure out your process that works, and don't be somebody else.
That's right. So I'm going to open the floor up to any questions. So in the audience, if you have any questions, please feel free to chime in. I realized halfway through the webinar that I think most of the audience was just looking at my face, and you were just in the corner, Sean. So I had to switch the view. But yeah, it's
probably for the better. I'd probably rather be looking at you than me. I'm hopped up, screaming at the screen on coffee. I got this new coffee that I found, and it's amazing. It's probably too strong, but it's amazing.
Awesome.
Super coffee. It's wonderful. It's got a couple different brand flavors of it, but I like just the black one. And it's 250 grams. I know I'm squirreling here. 250 grams or milligrams of caffeine, which it's awesome. It makes reading boring things a little bit less boring.
Well, that's great. I'm gonna have to get the name.
Yeah. Super coffee.
It's called Super Coffee?
Yeah.
Oh, okay. All right then.
Yeah.
Well, we don't have any questions from the audience. We have a few minutes left, and just want to ask you, Sean, before we sign off, can you talk a little bit about what we're holding in our models in the portfolios, maybe just the moderate and alpha. So the middle of the way portfolio, the moderate, and then the alpha portfolio, which is our most aggressive.
Why that screen is not working? I'll just jump over here. Yeah. So, there we go. It finally came up. Moderate, about 38% is equities. Alpha, about 48. So across the board, we're still pretty heavy in equities. Today was a pretty active buying day, just because you buy on red, sell on green. A lot of energy. Foreign exposure, we still have some Germany and Switzerland in there, Netherlands, Russia, Saudi Arabia, India, Thailand, Poland. But some of that is those countries economically are in a good spot. Some of that is, with Saudi Arabia and Russia, whatever the barrel of oil does, those countries' economies tend to do. That's a little easier one to understand. The next kind of big bracket that we're in is commodities. Moderate's like 16%. Alpha is 24%. Both of them, I think, have access to the same stuff. Yeah. Cattle, natural gas is the big one today. Corn, copper, coffee, cocoa, but we're fading out of that position. Soybeans, wheat, and the new one is uranium, and we were buying some more of that today.
Nice.
And then some bonds, not a ton. But the bonds that we do have are, positioned for a rising growth in an inflation environment. Again, all of this could look completely different in a quarter or two, and we will be completely flipped. I don't think even Alpha is even short anything right now. And it's not that there's not opportunities out there. It's just we've been selling it. We were short China for a long time, and then we just faded out of all of those positions. But that's the short answer of how we're positioned. And it's probable for the next, month and a half. This is about how we're going to be sitting. I'll be constantly buying and selling these positions. Like I said, I'm always adjusting our sizing. Mm-hmm. If a position starts ripping, I'm going to trim that. If something's red, like today, today's a buying day. Everything that's on my board, I still love. It's just we're going to get some more of it at a better price.
Well, all right, Sean. I think that that wraps up our webinar for today.
Cool.
Thank you for sharing, for all of your insight. Just to let the audience know that, what we share and discuss on here is not investment advice and just a conversation. And our purpose is to educate our viewers. If you are interested in seeking some personal financial advice on investing, financial planning, retirement, please feel free to reach out to us at info@nestfinancial.net. Also, this recording will be available on our site. So if you want to rewatch it or send it out, please feel free to do so. And until next time, we will catch you next month in December for the following Nest Edge. All right. Have a great day. Take care, y'all.
See you, everybody. Adios.